Welcome to the B.F. Anderson Technical Report for March 25th. I wanted to introduce a new concept this week, something new. What I'm going to do is I'm going to move forward with the shortest moving averages to the longest moving averages. So I'm starting out here with the NASDAQ using a 10-day moving average, a 50-day moving average, and a 200-day moving average. Now, we'll talk more about the 200-day moving average as we get into the video. It's very important. It's an important moving average. Now, the way to use this particular indicator, we're looking for a period of time where it moves above the 10-day moving average in very organized fashion. But then all of a sudden, we've noticed here kind of a change of behavior. And it broke below the 10-day and actually gave a sell signal on the 10-day moving average right here. Then we came down and was trying to work our way back up. And to get a buy signal, we're going to need to see some type of breakout above this level, and it's going to need to be on above average volume. Now, that's index number one. Index number two, and I want to emphasize that people should look at multiple indexes. Just don't look at the Dow, the S&P, and the NASDAQ. You need to look at more than that. Now, we look at 5. Now, here's the mid-cap index. This is the S&P 400. You can see here as well, we just got a sell signal on this particular index yesterday, so not looking all that well, and has, basically peaked, came down, broke the 10-day, then violated right here. So we'll just have to see. So that's index number 2, and we haven't seen a buy signal yet. Here's the New York Composite. This is all the stocks on the New York Stock Exchange. Again, we broke below the 10-day right here, and the rule is we have to close below the 10-day. Then you break that low, and there's what we call a violation. And we're seeing high volume on the sell side. We're not seeing a volume signature, which is very important. So that's index number 3. Index number 4, the small cap index, S&P 600. You can see here we broke the 10-day. We closed below the 10-day right in here. Then we violated, so we're actually on a sell signal on the small caps as well. And, this is a short-term indicator, but it does tell you that this market is difficult right now. And we're going to, again, look for that volume signature. Now, we had a big spike in volume last Friday, but it just has not confirmed any type of breakout to the upside. Index number 5. This is the S&P 500 large cap index, probably holding up relatively well here. You can see it did break below the 10-day, but the sell signal actually came back here where it broke below the 10-day and then violated, continued to come down, trying to work its way up. Just like the NASDAQ, we need to see some type of basing action and then a breakout to the upside, especially on above average volume. Now, going back to some of our other indicators, now this is the 25-day and the 50-day moving average. You can see again that the NASDAQ has broken below both moving averages, and we've gotten somewhat of a death cross here with the 25 crossing below the 50. Again, this is just a time to be very cautious and careful. Now, we're still in a bull market, though. This is a 35-week moving average. This is a very reliable indicator. I've used it for years. And basically what you're looking for is if it breaks below that 35-week moving average for 2 consecutive weeks, it really means that, maybe we're in somewhat of a bear market situation. But we're not there now. Trade the chart in front of you. This looks very positive. Now, on the aggression index, and we'll talk a little bit more in the video about the consumer staples stocks, but what we're doing here is just to remind everybody we're taking technology and we're comparing it to soap, toothpaste. Now, when investors become aggressive, this line goes up. So we made a high, we've come down, we've made a lower high here, and we're continuing to deteriorate, which is telling me that investors are putting more money into consumer staples right now than they are technology. So here's the actual indicator. We're still above that 40-week moving average, but really coming down, getting one of the lowest readings we've gotten in some time. But remember, we had a tremendous move in this indicator during, the fourth quarter of last year, first quarter of this year. and it's just basically consolidating, but it doesn't look positive. So again, the market's telling you, be careful here. Now, on our three economic indicators, Treasury, the 10-year Treasury note got up to over 17%, 1.7%. Man, I can remember back in the 80s, it did go to 17%. But anyway, 70s and 80s. But anyway, you can see here that we got up here fairly high, kind of coming back, settling down a little bit, but still in an uptrend. So interest rates are in an uptrend. Oil prices rolled over big here recently. We were seeing a move in oil, back above $60 a barrel. Now we're down about 57, 58. Now on financial stocks, with interest rates continuing to stay somewhat elevated, the financial stocks are continuing to hold up, continuing to stay in an uptrend. Now on new lows, this is Tuesday now. This was last Tuesday. We got a big spike in new lows. That's not a good sign. So we're starting to see the number of new lows picking up here. So again, just telling you to be cautious with your portfolio. Put call ratio, we continue to be in greed, so you should be in fear. Remember, when the reading is in fear, you should be in greed. Now, it's hard to do, but as we talked last week, the human mind has a way of allowing these emotions to interfere with making very good decisions. But right now, we continue to be in greed. Again, the problem with the indicator is that we can stay in greed for an extended period of time, but we are getting very aggressive readings here. Now, this is interesting. This is an interesting graph. What we've done here is we're taking the high-yield bond fund, junk bonds, and we're doing a ratio to Treasury bonds. Now, so if you think about it, if people are worried about default and recessions, they're not going to buy junk bonds. They're going to buy Treasury bonds. So as you can see here, now I went back to the March bear market, which is March 23rd bear market. And if you look at the ratio here, as long as the line is going up, it means that junk bonds are doing well relative to Treasury bonds, which are the safer bond. Well, you can see what happened here. We started to break down, then we made a lower high, and then we broke down bad, then we broke down real bad. So this was where the market said recession. Well, if you look at where we are today, it doesn't look anything like this. So basically, the market, I don't believe, because people are continuing to buy junk bonds. And look, these are very sophisticated investors. They're not going to just put their money in anything, and they're going for the higher yield on the junk bonds. And if they felt like, that there was a risk of defaults or a risk of recession, this would not be in such a strong uptrend. So it's an interesting graph. You can see here when it came down, we made the low in the market, continued to be in an uptrend. Now, on the VIX index, we continue to stay in this very positive area around 20. You can see back here before the crisis of the pandemic, we were basically in the 12 to 20 range, but we've gotten back into a reasonable zone. And I have to emphasize, when the market slows down on volatility, because volatility scares people and it makes them fearful. So when you get a low volatility situation, it makes people braver, more greedy, and so they come into the market. Just be aware of this. Now, I wanted to point out some stocks that are really looking kind of bad, just to kind of give you an idea of how to use the 200-day moving average. Because once a stock breaks below the 200-day moving average, it could be years before it comes back. So here we have Zoom Video, very popular stock, peaked out here, late last year, downtrend, continued to just kind of move sideways. Then it broke the 200-day moving average. I would avoid stuff like this. Now here is Tesla, kind of not as bad of a pattern, but similar, where you can see a peak here, around February. We actually sold the stock, I want to say right in this area right here where we got that violation, and then, it bounced back a little bit, but made a lower high, and it's continuing to work its way down. I kind of think that this alternative energy stuff may have run its course for now. Here's Teladoc. This was another very popular stock during the pandemic, where you would be able to contact your doctor over your cell phone. But you can see here the rollover, the breakdown. Here's the 200-day moving average continuing to break down. This stock doesn't look good. Could be a problem for years to come. Here is an ETF called the TAN, which is the solar stocks. Again, like Tesla, you see the very same pattern where you got this high around February, started breaking down, hasn't broken the 200-day yet, but it seems to be heading in that direction. I would avoid this kind of stuff at this point. Amazon, another example, just moving sideways all during this period, breaking down, breaking below the 200-day. Now look, we all know these are great companies, such as Amazon. These are great companies. I'm just saying that the sellers are overwhelming the buyers right now, and if you're looking to make an investment in something, you ought to really go where the direction is more positive. Now, here's Docusign, another very popular stock. We owned this stock in the past. It came down, breaking the 200-day, very negative pattern. Here's Peloton, exercise equipment that got real popular during the pandemic. Same pattern, breaking the 200-day. Now, I did mention earlier that the aggression index is starting to act weak. And we can see here that this is the consumer staples ETF. Well, it's a fund, a spider fund. I guess it's an ETF. Point being is, you can see here that we're starting to see an uptrend. Now, these are defensive stocks. This is like Kellogg's Corn Flakes. This is stuff that is very predictable. So when you start to see these stocks starting to rally, like utility stocks, you need to be aware of the fact that people are really putting the brakes on risk. They're really watching their risk profile. So should you. All right, so let's get into the top 5. These are just some of the names that we're picking up on our list. TripAdvisor kind of broke down. I don't know. I think I would stay clear of this one for now, but it's on the list. Now, realize this is just a watch list. Now, here is Spirit Aerosystems, which is an aerospace company. Again, strong rally, but breaking down. Kind of a failed rally so far. Here's Alcoa Aluminum, same thing. We got aluminum prices moving up. Copper prices are moving up. Steel prices are moving up. But you can see here, it kind of broke down hard yesterday, then trying to rally. But I would wait for this to consolidate. Devon Energy. Again, the energy stocks have been really hot here. But again, we're seeing somewhat of a breakdown. The market's just acting like we're going through rotation. It's trying to figure out where we're going. So in the meantime, I would keep my powder dry. Diamondback Energy, another energy stock, same basic pattern. So anyway, the point being is be cautious here. We're seeing a lot of weakness in all of our indexes. But if you have any questions, please give me a call. Thank you very much.